Hey Bulls, how we doing? What's going on? It's the Sherpa. It's Chase at Ever Bullish. It's the Substack, the Sherpa Substack.com for elite traders. I hope everybody's having a terrific day. Most importantly, I hope that y'all had a terrific holiday. I know it's not over for all the different celebrations out there. Get after it. And I'm here working for you. So I've got one of the best and most important info oriented educational pieces for everybody. So this is going to the Substack, and this is going to YouTube, and this is going to my website. So welcome all. Real simple, guys. This is called the January effect. These are the trading principles that I participate in as a professional trader, asset allocator, portfolio manager. These are things that I consider to be the most important, one of the most important takeaways that I've ever had in my 15-ish years of professional asset management and trading. So take it seriously. These do come out of the statistical resource, one of those statistical resources that I use, which is the Almanac. Be sure to order your Almanac. If you're going to get it from everbullish.com. Okay. We're going to go to everbullish.com, right? Every single time, traders. Hopefully you traders are sitting around in your PJs enjoying some of your most recent gifts that you got over Christmas. And we are going to take a look at it's going to make me open my system preferences here. Sorry about this. There we are. All right, thanks for bearing with me. Sorry about that. All right, so we go to everbullish.com to learn these lessons, right? If you want all my lessons, you go to the Substack and you subscribe. It's the best deal on the internet. But we're going to go to investing articles. We're going to go to today's date, December 26th. And let me tell you about January. So this is why January is so important, Bulls. Just a quick one. Y'all know we're all in cash in the professional portfolios. You know we're mostly in cash. I have one FAS option sitting out there for the 21st. That's finally in the money. Had to take a lick on the other one, and I gave you guys the credit back. So if anybody followed that trade, feel free to go ahead and send me the email on it, and I will pause your subscription for next month. So we're sitting on the same side as far as allegiances are allocated. But here we are, Bulls. This December has been marked with high volatility on the sales side, particularly in oil, tech, and financials, and a rally in consumer staples. When we see this happen, that means the market is playing defense. That means the market is scared. That means professional asset managers are buying things that they think might be good for a longer term, and that those things are the things that are good in bad markets, and those are the things that scare me. Not to mention we're at the mercy of a bunch of dipshit politicians, and then the Fed chair, which has been handheld and handcuffed since really 2011-ish. But this is, again, why I fundamentally believe in selling out when times get sketchy. And I'm proud to say that all of my professional portfolios, you can go back and check the tape on YouTube. I made the first video to sell out on the 28th of November, put limits underneath everything, and then be sure to 100% be out by the 15th. Our portfolios were out before that. Okay, so we missed some recent downs. That's pretty tight. Now we're going to reallocate. But what I want to do is wait. I want to wait until the first couple of days of January. So this is called the January effect. So let's straight up look at the facts. These are market statistics, and let's get you learned up. So January's barometer. So what January's barometer means is how did the month of January do? When the month of January in the S&P was up for the month, so the first trading day to the last trading day of the month was higher than, or was lower, or in this case, it finished higher for the month in the S&P, 74.3, so 3 out of 4 times roughly. The S&P predicted the entire course of the year. So January up, years up, 3 out of 4 times. January down, years down, 3 out of 4 times. Pretty good to know, right? Every down January since the S&P, in the S&P that is since 1950, preceded a new or extended bear market or a flat market or a correction of 10%. I don't really like this stat, but I put it in there because it's kind of true that if we have a down January, you ought to be on your heels, right? Your mutual fund manager doesn't care about that. He's got to keep your assets inside of his shitty investment products. Remember that. I don't. That's why you buy my portfolios. That's why you follow the Substack. S&P gains on January. S&P gains on January's first 5 days. So this is called the first 5 days barometer. This is a cool one. If the S&P is up in the first 5 days of January, preceded a full year's gains 82% of the time. So if January's entire month is up 3 out of 4 times, or 75% of the time ish, the entire market finishes up. If the first 5 days of January are up, that means 82% of the time the entire year finishes up, right? So if we have both, what does that mean? From a statistical perspective, that means we're sitting pretty high on the hog. On average, November, December, and January constituted the year's best 3-month span. So if you just crack open every 3-month span that is possible over a 12-month year, that would be 12 different spans. We would be looking at an average return of 4.8%. I don't love this one because it's kind of it's just indicative of the fact that October is historically the worst month, and it's, you know, September we're coming back. So of course, if you start a period to start tracking for 3 months, the one after the worst 2 months, or the, you know, just behind the 1 month, it would be looking a little bit better, right? But keep that in mind. And then in January, the Dow gained more than 1,000 points in 2018 and 2019. 2018 was roughly a flat market, but then 2019, y'all, you know, anybody could make money. Your drunk uncle could make money. That was just easy time to make money. So let's watch the Dow a little bit. Remember, y'all know that I don't like the Dow. I got the videos about that. I don't like the Dow as an indicator of the market because it's really not what it used to be, but it's still worth noting. Remember, this is pretty sick info, right? Remember that history does not repeat itself, but it rhymes. I've always liked that. So taking a little bit deeper of a look, let's look a little bit deeper now into the January effect. So this is actually the first 5 days effect. And the first 5 days is kind of like a warning system. All right. Remember, this info is really, really important. And I've been sitting on this for a long time, waiting for the beginning of the year. So this one's cool. The last 45 days, the last 45 periods of the market being up the first 5-day period. So the first 5 trading days of the year, 45 times that's happened, 37 times the market then followed. Okay. And gains in all 45 years. This is something to take into account when I'm telling you to buy my portfolio and go into the 3rd week of January. There is a method to the madness. There is a science to the reason. And if 37% of the time, or 37 out of 45 times, that is, sorry to be muddling this, that the first 5 days of the market is up, we're going to be up for the rest of the year. So I like to take that into account, to take a temperature and not just be blindly invested like your professional asset manager or the idiots over at Edward Jones. All 8 of the exceptions in this are kind of interesting. So all 8 of these exceptions, so 45 minus 37 equals 8, right? In this case, all 8 of those exceptions were in periods of war. So we had the Vietnam War, we had the first war in Afghanistan, and then the second. And that stat includes those periods of time. 2018 was a flat year. 2011 was a flat year. 2015 was roughly flat. And then in 1994 was flat. These were flat mostly because of stimulus, right? We got hyperinflation in 94, trying to tackle that. 18, we had all of the stimulus that we've currently been having. And then we had the beginning of the stimulus in 2009, and then the major double dips, quote, fear flash year. And then in 2015, God knows, I don't even remember. That's when gold and Bitcoin started rallying. So another cool one to take into account. We're almost done here, Bulls. Thanks for sticking with me, but this is more important to you than it is to me because I already know this shit. The post-presidential election years. So this is true of this year too. The indicator of the first 5 trading days of the year has resulted in being correct 13 out of 17 years. And now, actually, including this one, it'll be 14 of 18, assuming that the market doesn't drop 23% this week. So post-presidential election years, the metric of what the first 5 days of the market do is even more strong than 82.2% of the time. Remember, this is why my portfolios are in cash. This is why you should be following the Sherpa Substack, baby. And this is why you should be looking at history, not necessarily to repeat itself, but to rhyme and to have a little bit more intuition in your investments than just buying a mutual fund or paying some asshole to manage a managed account. I did leave the rest of this post up here. This is the type of insights you get when you join the Ever Bullish Edge, which is the Substack at thesherpa.substack.com. And if you want to buy one of my market beating portfolios, go to everbullish.com and buy them on the right side. They're in cash, but I'll email you the portfolio when it comes out. Love everybody. Wish everybody a Merry Christmas and a very, very, very bullish new year. AFG, LFG, LGR. Let's get rich.